either their own circumstances have changed, or I mean, a lot of people just don't simply understand that the value of anybody's real estate, mine, yours, anybody else's, is inextricably tied to whatever interest rates are. As interest rates go up, your asset value goes down, and no seller wants to ever acknowledge that his asset value went down.
This is the Real Asset Intelligence Podcast with your host, Derrick Barker, sponsored by Nectar. Access your trapped liquidity today at usenectar.com.
Hello, everyone. Welcome to the Asset Intelligence Podcast. Thank you for joining us again today. The topic of the day today is boring is beautiful. We're making the case for unsexy real estate in 2026. And why this is in 2026, everyone is hunting for a home run. There's distress in the market, so people are looking for steals of deals, looking for an AI edge to drive, out of market returns and trying to find the next hot market. Meanwhile, the mantra here at Nectar has been low leverage cash flowing assets, and the idea is that there is legitimate money in the unsexy stuff that quietly compounds, the stabilized cash flowing fixed rate assets in unglamorous secondary markets. Sometimes that boring is the smartest trade in real estate. So love to think about, we like to focus on how does a disciplined operator actually run that play. We have the perfect guest today in Stewart O. Heath. He built an entire firm on that thesis. He's been a CPA since 1987, who audited investors' books for years before becoming an owner and operator himself. Now acquiring and operating stabilized self-storage, medical office, and retail along the I-65 corridor with management in-house. Boring is beautiful is not just a tagline. For Stewart, that is his underwriting and his business model. So Stewart, welcome to the podcast. Hopefully that intro did you a little bit of justice, but welcome aboard.
Oh, I'm not near as great as that intro was. Thank you, Derrick. It's a pleasure to be here.
No problem. So before we dig in and dive in, I'd love for you to give a real 60-second background of how you got into the business, how you went from being a CPA to where you are now with the portfolio of real estate assets.
Sure. Well, as I said, I am a CPA. I became a CPA because my dad was a CPA and it seemed like a good thing to do at the time. And then got out of college and went to work for one of the great big international accounting firms and discovered that I'm a whole lot more entrepreneurial than most of my colleagues here. And so spent several years starting various businesses and trying different things on. And until I really kind of found the love of my life financially in real estate. Real estate fits my need for numbers, and it also fits my need for being able to almost set it and forget it, and to be able to work on something else as well. It's potentially passive. Now we do manage, and so I have a team that manages that. But so you just really can't ignore it. But I get to go work on acquiring additional, or is it time to sell this piece, or is it time to redo the parking lot, and all those kind of things. So so I've been doing real estate really since the year 2000. And all the while having a CPA practice. But in 2010, I left to take a couple of corporate jobs and ended that in 2017 when I got laid off from a media company. I said, well, I'm going back to my consulting roots and do some real estate again, and been doing that ever since. And the second go round, I stayed away from residential because I'd had a bunch of duplexes and condos and stuff like that, and I didn't enjoy that. It wasn't fun. It certainly wasn't boring. So I wanted to go into the commercial realm, offices and medical offices and retail, dealing primarily with business people. And so, here we are, fast forward 2026, and Harvard Grace Capital's got $48.5 million of assets under management, and we've raised a little over $18 million in shareholder in syndicated equity from our passive investors. And at the moment, I've got $25 million under contract with 6 more deals behind that in a pipeline that we expect will close this year.
Wow.
So.
That's awesome. That's awesome. That's awesome story. That's an awesome growth, to have, 50%, a pipeline is 50% of the portfolio. You mind giving us a little color? What does your portfolio look like? What are your current assets? What are the stories behind them? And then after, I'd love to know about the pipeline. But firstly, what does the current portfolio look like?
Yeah. We've got 8 deals that we have syndicated, 9 deals that we've done syndications on. 3 of which are medical office buildings, which is my favorite asset class. 3 of which are what I call suburban office buildings, and we started buying. Those were our first deals, office buildings, and back in 21 and 22, and people, office? Are you crazy? Nobody's going back to the office. I like to say, in the South, we all pretended like there was no pandemic anyway. So hardly anybody actually stopped going to the office. And that's certainly never applied to medical offices, because your doctor, you got to go see your doctor and he's not coming to see you. So suburban office is a little bit the same thing. Some people will call that service retail. And it's things like, perhaps it's a dentist, it's your insurance agent, it's a mortgage company. It's basically places where the customers go see, that tenant. And you contrast that to a Class A office building or a downtown office building. And that's just where traditionally employers have collected all their employees. Those are the ones that have always sort of struggled since COVID, but not the Class B or of the suburban stuff. We've got a couple of retail style buildings, and they're sort of pure retail with a little bit of service retail in there. And then we have one pretty large self-storage facility in Huntsville that was built for RVs. It's a niche place, so they're all large units, and we're actually expanding that one at the moment, and with the intent to sell that once it's stabilized.
You mentioned medical office was your favorite. Why is that?
Medical office is my favorite because, well, it's got the office component. You're dealing primarily with business people. The doctors will come in. They will put hundreds and thousands of dollars of their own money into the build out of that office. They usually want 7, 8, 9, and 10-year leases, so they're there for a real long time. A lot of times they tend to be a little less cost conscious, so you don't have to argue over the annual escalations, and they seem a lot more amenable to accepting triple net or other cost pass through situation like that. To me, it's just the perfect setup. Long-term tenants with built-in increases and a lot of cost pass-through directly to them. It really helps you set up your real estate side as a financial instrument, which is really what it is. So when you have good income tenants.
So with you're doing a lot of office, what kind of financing? A lot of people are scared. Medical might be before it, but a lot of people are scared. How do you arrange your financing? What kind of lenders are you looking for? And then what kind of return profile these type assets have?
So just in general office, what I call suburban office, on average, we're getting a double-digit cash on cash return. Our best asset is getting 13.5% cash on cash.
Wow.
We just computed it for the second quarter and are getting checks out this week. The financing has been relatively easy. As I said, we invest from Nashville down to Birmingham, Alabama. All real estate is local, and most financing is local too. So we've had great success with local credit unions, large, great big credit unions that like to put money to work, banks, that have a strong local presence because they know the market we're in. They look at the tenants just like we do, and that's and we buy the buildings based upon the tenant mix anyway, because that's that's the income.
Uh-huh.
There's a certain aspect to locality and the condition of the asset, but at the end of the day, the value of the assets is really based upon the tenants that are in there. But we've had zero issues whatsoever at finding lenders to come in, and we're doing conservative lending. It's usually 65 to 70% LTV.
Mm-hmm.
We're bringing 30% or more of the equity in, and because it is stabilized, and then you've got a little bit of a balance there between the first mortgage and the equity, and we're always trying to find the right balance to maximize return as well as cash on cash return to our investors.
Yeah. That's great. There are a couple ways to go there, but I want to just kind of do one more in the. So what is your typical investor like? You said both financing is and real estate is local. Is it local equity investors? Like where are you typically getting your equity investors, and what are the return profiles that they're looking for that you're pitching?
We got a bit of a mix. We have, as you might imagine, a fairly healthy sampling of those that are investing for cash flow and tax advantages. So we don't just do cash flow; we do tax advantage cash flow, if you can use it, because every property we do. We'll do a cost segregation study to maximize the bonus depreciation. At the very least, our cash flow should be sheltered from income tax for the first 3.5 years, just because of the depreciation allocations, which do roll over from one year to the next. So most, I'd say, 30 to 45% of our investors are cash flow investors. Others, we got a good third or more that invest through their IRAs. And so they're not all that interested in tax advantages, but they are interested in capital growth, but also stable investments. They're not running around trying to, buy crypto and IPOs out of their 401ks. They're looking for something that's going to grow over time, and cash flow, usually it doesn't shoot off like a rocket ship like SpaceX or come down like SpaceX, if you're looking at that stock today. But all assets that cash flow also grow steadily over time. So they're very, very stable, hence why we call them boring. So those are the two biggest pools of who our investors are. They tend to be entrepreneurs that might have already exited one company and want to generate additional cash flow. A lot of them are retired investors, and are looking for income. But most of them tend to be current or retired business people, doctors, and groups like that. We have another segment that are just people that are kind of getting started, wanting to know what it's all about. And so we do cater to people that want to learn about a syndication, and we're very happy to help educate folks. We have lots of resources available for that. And some people just want to invest because they like the area. So we will attract local people who say, yeah, my dentist is in there. That's a great building. I want to be part of that. And so out of our 80 some odd investors to date, right at 50% of those have invested with us more than once, and most of those have invested with us multiple times.
Nice. So walk me inside a Harvard Grace underwriting. What does boring look like? Like, what does that mean on paper? And what can you, like, what's attractive in the market? Where can you find these assets? And maybe even walking us a little bit through your pipeline.
Well, first and foremost, we have to make sure it's about the numbers. Okay, it's about the numbers, and so that's our first level of filtering through the funnel. We probably quick underwrite 15 or 20 deals a week. For those that we like, we request more information. And then from there, if we still like it, we'll make an offer. Yeah, if we make that cut, because we're hardly ever offering the highest price. So a lot of the deals that we buy are not necessarily interesting to other people. And so sometimes they are. There's a lot of competition on almost any medical office building. So I haven't secretly discovered medical office buildings. A lot of people did, and because they are so attractive. But we're in the running. There's 2 of those in our pipeline right now. I just made an offer on one in southern Birmingham yesterday, and so it looks like we've made that cut. So of the 6 in our pipeline, 2 of those are medical office buildings. One of them is a suburban office building, actually in Montgomery. So we'll be expanding our geographic territory a little bit, but it's still within our I-65 corridor. A lot of times the asset class dictates the cap rate or the purchase price that we're willing to purchase at. And we'll be buying that office building. That one's actually under contract. We'll be buying that at a 10 cap. And so we'll be coming out the gate with an 8% or better cash on cash return on that one.
So let's talk about that a little bit. You don't see a lot of 10 caps out there, or at least
No, you don't.
So like what is it? Is there a lot of deferred maintenance? Is there why is this trading at a 10 cap?
All the questions that I asked early on, what's wrong with it?
Yeah.
And perhaps getting a little bit back to what you were suggesting, this is an office building. It's in Montgomery, Alabama. So, we talked about my book before we went on the air. So one of my second rule number 2 is location, location, location. It's about the location. And every city has good locations and bad locations. And this is the best location in Montgomery, Alabama. A lot of people still say, well, it's Montgomery. Montgomery's not a great town. On a whole, it's mainly bad markets. At the same time, this building is beautiful. It is in perfect condition. And they've tried for some times, and there's this multi-ownership group with all kind of disparate desires and changes. So they'd had it on the market for a while with no takers. And finally somebody showed it to us, and they'd been to the altar a couple of times, and buyers walked away. And then their broker somehow hunted us up. So I didn't find this on any of the listing sites. He found me. It took me a good month before I got comfortable with it. I said, I don't know, man. So, and then I went down there and I saw it, and I met the owners, and why are y'all selling? I mean, this sounds like a great place. So they're actually settling out some estate issues for some of the owners. They've had some ownership changes. They need some liquidity. Nobody wanted to step up and refinance and guarantee that note, for the liquidity of others. Nobody wanted that. And so, that's part of what we do. We guarantee the debt on all of these properties, and so the refinance opportunity was not open to them, and so they priced it to sell. And, as they say in the automobile world, it's priced to go. Must be gone by midnight tonight, and so they needed to sell it, and they put it at a price. They've originally asked for like a 9.25 cap, and we've settled on a 10. So, some of that is art when you learn a little bit about negotiating. And I think I got the best price I could. But, it's 100% full with long-term tenants. And there's hardly any competition in a 5-mile radius. Because you want to talk about trouble financing office buildings, try financing a ground up office building, like a new office building.
Yeah.
It's nigh to impossible, which makes all of ours more valuable every day.
Yep.
Yeah. And, this is going to turn around. What's going to happen is I think we're going to get to 2029 or 2030, and suddenly there's going to be this big need for office space, and we'll have a 3-year window that it'll take anybody to be able to develop them and produce them and get them out there. And so cap rates for office buildings are going to come down, and which means prices go up, and we'll be sellers, when that market hits.
Yeah.
In the meantime, we'll just collect our cash flow and keep raising rates up. So
Nice. You call this cycle a target-rich environment.
I do.
Explain that. What dynamics make this a target-rich environment?
Well, yeah, the target-rich environment also pulls in the location. We love the South. It's what we know. I mean, and that's why we're here. It's because what we know. I'm sure there's other great parts of the country as well. Midwest, Texas, other markets that I don't know, and so we don't go there. So, but it's target rich because interest rates have come down from their highs of this recent Fed debacle cycle, and all throughout that cycle, sellers were used to selling at 5 caps and 4.5 cap prices and stuff like that, which was just really too rich. But interest rates are now coming down. Sellers have gotten more used to, a little bit lower price, if you would. And so to me, it's target rich because there's some great assets where the sellers and the buyers are now kind of more easily coming to terms. I thought it might have been a little bit more vibrant now, but we've had this war going on, and then interest rates came down a little bit more, and then the war got started again, and so where we need is for rates to be more like 6 to 5.5 and stuff like that, and then you're just going to see transaction volume go through the roof. They're at 6.25 now. That's not a bad rate. If you can't make a deal work at 6.25, then you're paying too much. But you got a lot of sellers that aren't willing to sell. They'll just hold. So to me, the target-rich environment is sort of the happy medium where buyers and sellers are really all agreeing to the same price, over and over and over and over again. So that's what that means to me.
And you've seen a lot of sellers that are now willing to come down to prices that cleared the market?
Yeah.
Okay.
Yeah. Either their own circumstances have changed, or a lot of people just don't simply understand that the value of anybody's real estate, mine, yours, anybody else's, is inextricably tied to whatever interest rates are. As interest rates go up, your asset value goes down, and no seller wants to ever acknowledge that his asset value went down. He might realize that he can't sell it for the price that he wants because interest rates went to 8.25, 8.5 as they were a couple of years ago. But that's the
reality. Saying that all the people that come across, and naturally we see hundreds of deals every day, but we say everybody who comes through, they all believe that their foundations are made of gold. Yes, absolutely. Yeah. I mean, in my market area, Huntsville, Alabama is the hottest little city probably in the South. And a lot of government spending, a lot of industry spending. And I mean, it's been on a tear for 15 years. And everybody who owns property in Huntsville thinks that it's made of gold. It's like there's a platinum mine in the foundation. Mm-hmm. And I just have to look, all real estate's local, but all financing is global. I got the same interest rate on my 10 cap property in Montgomery as I do on my 7 cap property in Huntsville. And so, even though you got the local lenders that are interested in it, their interest rates are set, nationally, essentially. The only possible exception to that is the credit unions, who we all know don't really live in the real world, but they'll usually be a little bit below bank rates, and give great terms, but which is why I've used them so often. But they're not earth-shattering rates. I mean, I can't go get a 5% loan today from a credit union. I can get 6, and the bank might be 6 1/8.
something like that. But yeah, so it's always, that battle of wills with the seller, trying to get them to accept the reality. And the only thing that woos them is their own need to sell. And if they don't need to sell, they're not coming down on price. So, nor should they.
Yeah. If you believe it's worth X and all your offers are at X minus Y, then you can just own it at X. You are the market.
It'll eventually be X.
It'll eventually be X, and that's because either
it will eventually be the price that you want it to be. It might be 10 years. It might be
Either X will change, or X will change, and either it'll go down to where the market is, or the market will come up, and but like eventually, X will be met.
A beach condo might catch his eye, and then all of a sudden it's 0.8x.
Exactly.
So,
exactly.
Yeah.
So you do a lot of different asset classes. You say you're on the I-65 corridor. Where are you seeing the best? If you're focused on cash flow, where are the best? What deals are the best from a cash flow perspective today?
Today it's office buildings because you can get them in 8, 9, and 10 cap prices. Medical office buildings are usually in the lower 8s. If they've really done it right, you can probably justify, a 7.5 to 8 cap price on a medical office building. And so, your cash flow, the best cash flow is completely dependent on what you paid for it.
Yes.
So the higher the cap rate, the better cash flow deals. That's why we're so excited about our Montgomery deal. But we are also long-term investors. And so
when you say long-term, what is your time horizon and what are you looking at? Because, Montgomery, I'm guessing this not that liquid going in, it's also not that liquid going out. Like, can you talk about how important your exits are to you and what kind of time frame is a good?
Our time frame is more like a 10-year time frame. Now we do present to our investors a 5-year outlook, a 5 to 7 year outlook, for them to basically get all their money back. We do, our standard MO is, operate at year 3 to 4, call it midpoint of year 3. We will refinance that property because we should have, almost always have grown the NOI, the net operating income, made that building more valuable, refinance that, typically with the goal to get all of the investors' money back to them through that first transaction. And sometimes we get 70%, sometimes we get 110%. And that doesn't necessarily mean we're buying anybody out. It will reduce the distributions going forward. But they've got cash back in their hand that they can go do a new deal. They remain an owner in our deal, and cash flow distributions will continue and start growing over time. Again, we believe in a bit more of a natural time in the asset's life to sell it. We're not fee driven, so we're not going to say, okay, I got to sell this thing because I've got to generate fees. For my shop, and so we got to sell that building. Whether another 2 years on it, might be the best thing for that project. That's why I said we're more like 10-year hold people. And if I'm the primary owner, it could be a 20-year hold. So. Yeah.
So, we're coming, we've gotten a lot of pretty good wisdom from you, but you've been doing this for a while. You've been through a couple of cycles. And before that, you were looking at the books, of developers and things like this. I'd love to shift to a little bit of, durable wisdom. But first, you literally wrote a book, about what not to do. I believe that you mind talking a little bit about that. And what can we learn from that?
Yeah, I've been doing real estate for about 26 years now, I guess. Started in 2020. Made a lot of mistakes along the way. Did not get through, the great financial crisis in whole. And so last year, really I've done a lot of podcasts, and I realized, hey, here's one of the rules I live by, and I would say stuff like that. And then I thought, well, I should put this together in a book. And so, we put this out last year. Don't do what I did. 10 rules for investing in commercial real estate. And Each chapter is one of my rules, and it starts with a bit of a personal story. Usually it's my own personal story. I have been able to learn some things by watching other people. I haven't had to make every mistake myself.
The cheaper way to learn.
That's the much cheaper way to learn. And so each rule is a hard-learned lesson. My next book will be called "Everything I Ever Learned, I Learned the Hard Way." There's good practical advice. Here's what to do now, and we really live by this now. And so, anybody who wants it, just go to my website and fill out the form, and we mail it to you for free. It is available on Amazon, but please don't buy it there. So that would actually cost you money, and we don't want you to do that.
What are your top 3 or top 5 rules?
Sure. Rule number 1, you make your money on the buy, not the sell. If you don't buy it right, in other words, you pay too much, you're never going to make that up. There's no way mathematically or whatever, you're never going to make that up.
Yeah.
And you might still make good money on that property over time, but you will never have made as much as if you had bought it right to begin with. So you got to be patient and disciplined when you do that. Rule number 2 is location, location, location. Leverage is location. Location is leverage is what we actually call the rule. And what that really means is it's not the right city. It's not even the right submarket. A lot of times it's the right street, and sometimes it's even just the correct side of the street. I mean, the right location is a microcosm, because you got to be looking at markets a quarter mile away, a half mile away, 1 mile away, and 3 miles away as you're evaluating each potential. Storage is case in point. Your storage unit has a pull of about 3 miles. That's your market. It doesn't matter if Huntsville, Alabama has a shortage. If you put it in the wrong part of town, you've made a mistake.
Yes.
So that's sort of an example. Third rule is know your tenants. You are in business with whatever business your tenants are in, you're in that business too. Which is why we spend most of our time in our due diligence, in our underwriting the tenants. We don't do single tenant stuff. We don't allow tenant concentrations. I don't want a property where you got one tenant that's 40% of the building.
Mm-hmm.
To me, it's just, we diversify risk at every possible level that we can. So those are the top 3.
Those are great. Those are go along the lines of just Nectar's overall underwriting, basis. It's the same thing as, you got to buy it right. You can never operate your way out of a basis that's too high. I think some people 2021, 2022. I think people are learning that right now.
you can have some accidental brilliant things happen to you, like our first office building that we did. The city put in a sewer moratorium 2 years ago, still hadn't been lifted. Nobody can build anything. And so my rental rates just keep going up and up and up and up, because there is no available office space in that town in a 3-mile radius. And I didn't put that in my pro forma. Mm-hmm. I don't even take credit for that. It just is what it is. So even when you have great things like that happen to you, it still doesn't cure a bad going in price. So
Yep. What is one piece of conventional real estate wisdom that you think is either misguided or wrong? What should people take away that everyone else is saying this, but you should really think this?
That's a good one. Yeah, a lot of people will say something like, grow your business at all costs, and kind of just like tacking on to what we've just been talking about. At least in our business, I just think that's wrong. You have to be patient and deliberate, and making sure that your growth is coming at the right price. And it's easy to get tied up and fall in love with a building. I fall in love with all of my buildings, but I surround myself with people that say, all right, Stewart, that price is too high. You're right. They have to pull me back, on the numbers. Be disciplined to your numbers. Don't lie to yourself. But growth at all costs is, I completely disagree with that. I used to work for a guy who's, we were in a subscription business, and our lifetime value was about a year and a half for a subscriber, and he was willing to spend like $150, which was basically the lifetime value of 2 years.
Oh, wow.
He was willing to spend that much as a customer acquisition cost for growth. I'm just like, that math don't work. You're going to spend 2 years of revenue and only have them for a year and a half. But in the short run, that looks really good, and makes the top line look great, but the bottom line, not so much.
Yeah.
You have to grow responsibly.
Awesome. Well, this is awesome. I think your Harvard Grace Nectar or like kindred spirits, believe in boring, low leverage, cash flowing real estate as a way to build wealth. So thank you for joining. Before we leave, is there any one thing, if you're for the operators out there that are young and building a business, that they should remember from this conversation? Don't no grow at all costs, location, basis. But if there's one piece of advice that you want to give a younger person building a business in this space, something that you learned, what would it be?
Work hard and refine your investment thesis and stick to it.
Awesome. That's beautiful. Work hard, refine your investment thesis, and stick to it. I like that. All right. Well, Stewart, thank you again for joining the Asset Intelligence Podcast. It was great having you. I'd love to have you back one day.
Thank you, Derrick. It's been a pleasure.
And thank you for listening to the Real Asset Intelligence Podcast. Find out more at usenectar.com.